Welcome. My name is Daniel Gerlay, and I'm the president of the Global Young Entrepreneur Society, an international organization supporting exceptional young people in accomplishing their entrepreneurial ambitions. Our guest today is Elvin Guri, a distinguished private equity investor and entrepreneur. He is the CEO of Empower Capital and Invenio Partners. Elvin has a successful track record of investment in various sectors, including financial institutions, telecoms, technology, biotechnology, healthcare, and real estate. Elvin co-founded JetFinance International, the largest independent consumer finance lender in Southeastern Europe, which was later sold to BNP Paribas. He began his career as an auditor at Price Waterhouse and later worked at the European Bank for Reconstruction and Development. We are very pleased to welcome Elvin Guri.
Thank you, Daniel, and thank you for the opportunity to speak to your audience.
It's a pleasure to have you. Today, you are well known as an entrepreneur and investor. What is your story?
In a few words, I've been lucky to be relatively good in good times. Most people in business, most aspiring entrepreneurs, seem to downgrade the effect of luck and the impact that luck has on our lives. So we tend to refer to luck favors the brave. The more I work, the luckier I get. The harder I work, the luckier I get. But there is sometimes a confluence of events. Events conspire that can bring about luck or lack of it. And by that standard, I have been exceptionally lucky. I was exceptionally lucky to win a scholarship to attend the American University in Bulgaria in the early 90s. I was very lucky to make the sort of acquaintances that shepherded me through for my first job at Price Waterhouse, and then for my second job at the European Bank for Reconstruction and Development, and so on and so on.
What is the founding story of JetFinance International?
I think any such story of successful entrepreneurs should be looked through the lens of a personal journey. For most of my 20s, I spent a lot of time trying to figure out who I am, what are my strengths, what are my weaknesses. Following that period where I had bouts of insomnia because of the stress created by these not almost, but existential questions, I ended up figuring a couple of things. First, I'm no genius. Therefore, I cannot rely on the world-changing ideas to succeed professionally and personally. I need to do the hard work. The next best thing is to, other than having a world-changing idea, something that one can patent, protect, or otherwise make unassailable from competitors. The next best idea is to take concepts, ideas that have worked in other circumstances, in other countries, and seek to apply them and adapt them as intelligently as possible in your chosen market. And that was what I chose to do. By chance, luck again, one of my friends who was managing a bank in Bulgaria started telling me about this concept of consumer finance that had just started to be applied successfully in Central Europe. I thought it was intriguing. It coincided with the time that I was starting to think, what's the next stage in my career development? I'm reaching my late 20s. If I'm ever going to start something new, probably this is the time. I have some experience. I've set aside some savings. So I have a certain basis from which to build. So I thought this idea was intriguing. I started inquiring a little bit more. I did some market research, and I reached the conclusion that this is the sort of thing that might work in my environment. And that's how I started. That's how we started. A small group of people with 20 square meters of space in the center of Sofia, and 4 people and 5 computers. We started with 1 loan application a day on the 13th of November, 2001. The product that we chose to, and the business that we chose to do was consumer finance. Financing initially the needs of the population for basic consumer goods, TVs, refrigerators, mobile phones, computers, furniture, and so on. And then little by little, selectively, also the wants. We figured that inexperienced as we were, if we financed first the needs, people were less likely to default on our loans. As we would get better and more sophisticated in our approach and in our risk management, we figured we could also end up financing the want, the good to haves. And this turned out to be the right approach. So over time, we did a few things that were being applied for the first time in the financial market, in consumer finance market in Bulgaria. We automated the processes. We started applying statistical methods. At that time, they were being called neural networks, scorecards, the sort of things and the sort of approach that today has become fashionable to call AI. Rudimentary forms, early stage forms, but that's what we were doing. And we were hiring only people that had no experience in financial services because we thought that they would be encumbered with the sort of methodology and mentality that came with being a bank. We wanted to be a bank of a new generation. That also worked out well. We also were inventive and innovative in the sort of financial instruments that we applied to fund ourselves. We brought on board private equity funds. We ended up raising funding in the London Stock Exchange. We, over time, expanded our product range to include not just simple loans for buying particular items, such as TVs, but also into cash loans. We launched insurance and so on. By the time we sold to BNP Paribas, we were providing hundreds of thousands of loans a year. We had close to 750,000 customers, a very significant amount, close to 22% of the adult population of the country. I don't know how many computers we had, but we had close to 3,000 people. And that had become a very serious force in consumer finance in Bulgaria. This project that we started ended up becoming a very successful subsidiary of BNP Paribas Consumer Finance. They were very happy with it for the next 17 years until they decided to sell.
What were the early days of JetFinance like, building a consumer loan company in Bulgaria?
With my partner, with whom we were managing the business, we always like to think ahead. In the very early days, we already had an organizational chart, one that described the business today, and also one that described the business as we wanted it to be in 18 to 24 months. We always believed that change would happen in the market, whether we wanted it or not. We would either lead the change, we would either bring the change about, or we would face the consequences of change. We resolved to be the people who would bring about change. And that required that we should be forward-looking in terms of the organization that this would require. So we did that. We consciously started also preparing our people that were very young, very inexperienced. For many of them, this was the first job. We started preparing them for the eventuality that they would become the middle managers of the structure. Even though in the early days, each of us was doing a little bit of everything, we were keenly aware that our different characters, my partners and I, also meant that our talents were best given to certain activities. So my partner is an organizational genius, and that includes structuring and systems and processes and procedures. Whereas I am more of a people person, more of a marketing oriented, more of a big picture guy that looks and thinks strategically. So while my partner was spending his time running the operations, I was going around the country, expanding those operations, hiring people, setting up new offices, encouraging people, especially in tough times, but also collecting feedback, both from the market, from our partners, from customers, and from our own people. At one point, I was doing 10,000 kilometers a month, which in a country that at that time did not have an ideal road infrastructure was very tough. It took a toll. The whole enterprise of starting a business that has ambitions to change the market takes a very heavy personal toll. And we were aware of it. We just weren't aware of how big a price that would be.
So do you have any advice for someone wanting to change a market with their startup?
Well, first of all, don't start too young. You need to have some life experience, not just work experience. You need to be slapped around a couple of times by life before entertaining ideas of setting up on your own. The reason for that is that such enterprises, such endeavors do not usually fail because the market is not there, because the product is not there, because the product and the market fit are not there, or because finances is not there, or because your people don't work well with each other. They usually fail because the founders do not get along and they get distracted fighting among each other as opposed to looking after the business, or because the founders and the investors do not get along. The overriding task of the early days of a new enterprise must necessarily be establishing a dynamic of conflict resolution, how we react when the going gets tough, how do we address misunderstandings, conflict, diverging points of view, generally, but especially when the going gets tough. And in order to be able to do that well, as a prerequisite, you need to have some life experience. You can't just read books in the evening and then go back in the morning and say, listen, I think this is what we ought to do.
Well, I'm not sure all of our audience would agree with everything you just said.
I'm not looking for agreement at this point. Listen, not all advice is applicable all the time to all audiences in all circumstances. It's just that advice, it's guidance. You pick and choose whatever works for you.
Before we get into your investment philosophy, can you share some of the most exciting investments you've made and perhaps how you made that transition from entrepreneur to investor?
Ever since we got out of JetFinance, and I was 33, 34 at that time, I faced an existential crisis. The crisis had to do with the fact that when you're growing a business, when all of your attention, all of your strength needs to be in ensuring that this business survives and prospers, you cannot afford too much uncertainty, personal uncertainty. You cannot afford to put into question your reason for being. Throughout the time that we were building JetFinance, both my partner and I thought that we had both the questions and the answers of life, or most of them. As we decided to sell the company, and as we were getting out, we started experiencing an insecurity. Over time, that insecurity manifested itself in basically psychological crash, especially when we finally, each of us separately, realized that not only did we not have the answers, but we also did not know the questions at this stage of life. And then it dawned upon us that at different stages of life, there are certain questions and certain answers that are universal, and there are certain questions and answers that are not universal, that are age-specific, so to speak. In my case, having paid a very heavy price, physical, psychological, and so on, for the success of JetFinance, I decided that I wasn't prepared to bear the burden of managing thousands of people or creating something from zero. I wasn't prepared to pay the price for it. That forced me to look for other ways of continuing my entrepreneurial journey. That's how I ended up from a founder, manager, CEO, to investor. This journey required a few years of getting used to the process, getting used to the fact that you have to rely on other people to manage businesses. And ultimately, I realized that what makes the difference between a good and a bad investment is it contains some of the ingredients that we used to consider as important when making an investment, chiefly the dynamics of the conflict resolution between founders themselves and between founders and investors. So as an investor, I focus a lot, especially in the early days, in either creating those mechanisms or improving and perfecting them where they do exist. So from this point of view, from this standpoint and perspective, our most successful investments were those investments where we saw eye to eye with our co-investors, and with our partners in management, the founders. The most successful of which was an investment in a life sciences company where we started almost from zero. They were doing €500,000 of turnover. Together with another co-investor, we invested equally €300,000 each for a total of €600,000 for 60% of the business. We helped to both create a management team, a structure, reporting systems, and so on. We helped the company internationalize, become a regional leader in its chosen field. And ultimately, we assisted the founder when he decided to exit the business. This particular investment brought about a 67-time return. Mind-boggling, especially when you consider the fact that we are not that good. We are that lucky sometimes. We have done other investments in larger companies where we have taken advantage of the opportunities of the dynamics of the market and have worked with a wide range of stakeholders, from employees to regulators to clients, to put together a product that works for the market, but also makes the employees proud to sell or to be associated with. Such a case in point was our acquisition of Telekom Albania, a subsidiary of Deutsche Telekom and Cosmotel Greece, which we restructured, appointed new management, promoted people from within, in the process gaining market share, launching new products, revolutionizing the market for, especially for retail services, and eventually selling to an eager strategic investor. That was also a very successful investment on its own.
What are your key considerations when making an investment?
As investors, we may have certain preferences or certain specialization in industries, but you can never know in detail and understand each industry. Here, I have found, with hindsight, a very useful thinking framework, one popularized by Charlie Munger, Warren Buffett's partner, who called it a lattice work of ideas. You might want to consider reading a book called Investing the Last Liberal Art. The reason for it is that it helps to put into perspective a liberal arts education and approach to life and to business. In other words, seeking a basic understanding of how things work in a few major areas of industry and of life, from mathematics to biology, for instance, and psychology and sociology. And then seeking to put them together in order to create a thinking framework, how to approach a particular investment. And in the process, you find that there are certain things, certain principles that are almost universally applicable. As I hinted, in my case, I think the relationship between founders, the relationship between founders and investors is crucial in any investment that we make, regardless of the industry. It's not the only factor, but I would consider, especially for early stage companies or for smaller companies, that to be the most important factor. At an early stage companies, whether they are single founder or a number of founders involved, they are basically an extension of the character of the founding team. With all the pros and the cons, with all the positives and the defects and the deficits. So, as investors that specialize in investing not exactly in the beginning at seed stage or early stage, but at growth stage, our goal is to help these companies corporatize themselves, create the backbone, both organizational and digital, to allow them to grow with quality and profitably, sustainably. In the early days of an investment, we cannot add much value when it comes to the market, because by definition, we don't understand much about the markets. Over time, all we can do as investors is to learn how to speak intelligently and to contribute intelligently to strategic discussions at board level. And that's what we need to learn how to do.
You touched on how the relationship between co-founders is critical to the success of any venture. So as an investor, when meeting founders, they're obviously trying to put their best foot forward. So how do you make that judgment?
Well, first, we have covered this in an earlier discussion with you, but I'm very careful when describing founders as entrepreneurs. Entrepreneurship, as I think I've mentioned before, to me is a way of life. It's a philosophy of living life. It's about people that are restless with how things are and seek to find solutions to problems, both in personal life and in the organizations where they, or the environments in which they function. That means that you look for solutions, but you also bear the responsibility for the consequences of those solutions or decisions. Not all founders, in other words, are entrepreneurs or entrepreneurial. And you can be an entrepreneur in your personal life, you can be an entrepreneur in politics, in business, in nonprofit organizations, in crime. And most successful people in all of these areas are entrepreneurial by spirit. So, my first order of business when meeting teams or meeting founders is to seek to establish, to my satisfaction, whether the people that I'm to whom I'm speaking are entrepreneurial, and then I proceed with seeking to ascertain whether they have a conflict resolution mechanism amongst themselves or how they react to crisis. Sometimes this process involves targeted questions, provocative questions. Sometimes it involves precipitating a certain crisis, a mini conflict. And sometimes it may be a simple, how often do you fight with each other? Do you argue with each other? When was the last time that you argued about? What was it about? How did you resolve it? And I seek to, in all of these conversations, to differentiate between consensus and compromise. To all early stage founding teams or to aspiring entrepreneurs, I always recommend the same thing. Aspire, work for consensus, avoid compromise. Compromise comes with regret. Regret carries with itself the seed of disagreement in the future. And there's always a price to pay for that.
How do you support the growth and success of companies in your portfolio? You are quite an active investor.
Yes, we are pretty unusual in that we are extremely hands-on. Typically, that means that we spend a lot of time with our founders, with our co-investors, so that we establish both the conflict resolution mechanism, but also consensus on the most important matters related to the company. Consensus means seeing eye to eye on whatever the strategic issues that the business faces today and in the future. And we do that through constant communication. I think that there's no more important skill in life, not just in business, that ability to communicate, ability to articulate your ideas well.
Any suggestions on how to develop articulateness?
Well, a liberal arts education certainly helps. But I am biased. I went to a liberal arts school first. Second, a bit of life experience also helps, because no argument is as persuasive as the one that comes from personal experience. It helps establish a common language and a common ground with the interlocutor. But finally, it doesn't have to do only with experience or knowledge. It also has to do with a character trait. You should never give up on seeking to communicate and to speak with other parties. Never. Otherwise, there's no way that you can reach an agreement. I remember one of my first classes in anthropology in university, and I took anthropology because I had to. It was part of a liberal arts education. You had to take the sort of courses that you'd never think of. And I wasn't willing to take it. It was one of the few courses that had space. I don't remember what I did in business or applied economics, which were my chosen fields. I do remember what I did in history. It was a chosen field, but it is also my favorite subject. And I do remember what we talk about in anthropology, because the first topic that we discussed was communication. And our teacher said, communication is key because with people that I like or I get along with, communication is very easy. You basically don't have to say much. But most of the world is people that you don't know or people that you don't like or you don't get along with. It is with these people that we have to communicate. It is with this sort of people that we have to establish common ground and consensus.
Which markets do you believe are overlooked or hold significant potential for entrepreneurs today?
Well, if I knew that, I'd be sitting somewhere in Wall Street, top of the world, rather than at my home in Bulgaria. My perspective is limited. My perspective is limited because I don't look for markets where I can make money. I look how I can make money by working in my region. I look how to contribute, to add value to Bulgaria and to the countries of the region. Perhaps some people would say that is limiting yourself because these countries are tough or because you'll never be able to make a huge amount of money, but that's not what drives me.
Are there any industries you would suggest everyone to avoid? Like some people would say restaurants are a terrible business and you should never invest in a restaurant.
In most businesses, at least the ones that have come across my desk or the ones in which I invested, the difference has not been on the idea. The difference between success and failure has been on the quality of execution. So, off the top of my head, I would say that no industry is that bad or so bad that you should avoid it altogether. That is an oversimplification because it is better to have a mediocre investment in an up and coming industry that is becoming fashionable than to have a fantastic company in an industry that is out of fashion or otherwise decreasing in importance.
If there's an incredible founder in a declining industry, do you still invest?
We have seen opportunities in such industries. Usually they're called defensive industries. And we have done reasonably well. We have not done spectacularly well.
Do you invest in competitive rounds for startups that are highly in demand, or do you try and be the main bidder?
We do not participate in rounds. We seek to be major investors, either control or strong minorities. But that means that's because we invest in grown-up businesses, businesses that have validated their business model, companies that are now teenagers and they need to grow. So that's not a reflection, negative or positive, on colleagues that specialize on early stage. So perhaps my observations might not be applicable or relevant to most of your audience. My choice of investment is always to do bilateral transactions because it is the best way to establish common ground and to establish a consensus, if you will, with the founder or the CEO or the management team of the other party. Any process that pits against each other various sort of investors limits both face time with the other side, and it limits also the possibility for all parties to articulate what they do best. As a seller, I am best served when I run a process. As a buyer, I am best served when I avoid the process.
So have you ever participated in a bidding war for a company?
A few times, yes. But we've never been the highest priced. We've always been the ones that provided the better value in terms of price and what we bring to the company in terms of experience, expertise, and in some rare cases, also reputation.
What advice would you give your younger self when starting your entrepreneurial journey?
Learning to trust your instincts more, especially in those cases that you are sufficiently confident that you know yourself, would have served me a lot. Mind you, I don't regret taking the steps and the decisions that I took. After all, they brought me here. But some decisions I could have taken differently.
Are there any particular ones you can share that you think may resonate with our audience?
Sure. In the early days of the great financial crisis, we are talking autumn of 2008. The week before Citibank and AIG got saved by the Federal Reserve, by the regulators. Oil was at its lowest point in, I don't know, a long time. Shares were at their lowest point, including Berkshire Hathaway. So I get together with our bankers and ask them, how about we dip our fingers a little bit into the market and buy the market? We don't buy specific shares. We buy blue chips, the blue chip index. What do you think? They turned around and asked me, what do I think? And I told them, what am I paying you for if you're asking me? All instincts in my body were screaming, we have to take an exposure. We have to take an exposure. But I didn't. And I didn't because I do not like to speculate. When I take decisions, I take them by weighing uncertainties and risks. At that time, I wasn't sure that I had a good sense of the risks, let alone of the uncertainties. What Donald Rumsfeld very memorably called the known unknowns and the unknown unknowns. And usually I do not invest if I cannot assess risk and price it. By pricing it not simply in the financial sense, but also in the sense of what's it going to cost me to make a success out of this investment in terms of efforts and in terms of dedication. And if I'm not convinced that I'm prepared to pay that price, I pass on it. I passed multiple times on Bitcoin, for instance, because I don't understand it, and because I reached the conclusion that even if I made money, I wouldn't learn anything out of it, and I wouldn't be the better for it, other than in financial sense. But that's not what drives me.
It's interesting you say that, as many entrepreneurs and business leaders would say that the opportunity lies in places of uncertainty where you don't even know the risks at all.
Certain risk takers would say that. Certain founders would say that. But to me, an entrepreneur is someone who is a risk manager, a risk optimizer, a control freak, more than anything else. Risk taking can definitely be rewarded and rewarding, no question about it. But that's not who I am. That's not who most people really are. Risk taking involves higher luck, a bigger dose of luck than usual. And that's not something with which I feel comfortable.
Something you said there was entrepreneurs should be control freaks. So what do you think about delegation, entrepreneurs giving full responsibility to their employees versus understanding everything that's going on in their business?
Then let me qualify what I had in mind with control freak. What I had in mind was someone who obsesses over risks to the business, both business risks and other environmental risks, if you will. For instance, I know a few people, and here I include myself, that do not travel with their partners on the same flight, ever, because they know that if the plane goes down, there's no one to look after the business or after the family, after the kids. That's the sort of obsession over risk that I had in mind. Control freaks that end up micromanaging because might as well do it myself, because I cannot trust other people, then these are people that typically end up with small businesses. Because if you cannot if you cannot let yourself be dependent on other people's capabilities and knowledge, you will not get very far. Even those people that have ended up building fantastic organization and have been called micromanagers, control freaks, such as Steve Jobs, they were obsessive on certain things, not control freaks and not micromanagers. I think this distinction should be very important in the minds of those people in your audience that are aspiring entrepreneurs.
We are nearing the end of the discussion. Are there any business books or other learning resources you would recommend for young entrepreneurs?
I already mentioned one, Liberal Arts, Investing the Last Liberal Art. And I'd say anything written by Peter Drucker. My Bible in that regard is Innovation and Entrepreneurship. That's a book that I can safely say changed my life.
I guess we can end on that note. What a wonderful discussion packed with so much insight and experience. So on behalf of the Global Young Entrepreneur Society, Elvin Guri, thank you so much for speaking with me today.
Thank you, Daniel. Always a pleasure.